Awesome. I see people here still joining, but we'll get started. Thanks everyone for coming here. Hope you're all doing well wherever you are in the world. So let's get into it. Today we'll be talking about crypto's evolving dynamics. And so we'll cover the theories behind cycles in crypto, how they've behaved historically and how they have evolved over time. And here we'll focus on two main areas. So the key players that have evolved during these cycles, the main participants and their behaviors, as well as the sectors that have come out of crypto throughout time. And finally, we'll have a future outlook on how the space is likely to continue to evolve over time. But first, as usual, a quick update about IntoTheBlock. We announced some partnerships with exchanges such as BitGet, and data provider like Bityard, and as well as a few hedge funds on API side. On the product side, we launched a new release of indicators, ownership indicators. So these are 10 indicators that we have been teasing for several months, and we're excited to finally be able to launch. Things such as tracking the behavior of holders with 1 BTC, 10 BTC, 100, etc. The inflows and outflows of these addresses, whether the whales are accumulating or selling their positions. We had gotten several requests about these indicators, and so we're excited to finally launch them. And we've covered these on several articles, as well as on our resources page. So moving on to the main topic for today. First, we'll get into crypto cycles, if there's anything to them. So as many will know, several things in nature and finance elsewhere. It's a strange clicking noise. Quick pointer, by the way, that I forgot to mention before I continue. I'll be checking. I have here my monitor, and I have an eye on the chat. Seems like there's an issue with my mic. Maybe this is better without the sweater. So if you have any questions or comments, especially if they're regarding a particular slide or audio issues, I'll be keeping an eye here. Anyways, I hope audio is better now. Let me know if, okay, it seems it's better now. Continuing with the topic, cycles are present all over the world. One of the most known is the business cycle, which is typically 7 to 11 years before there is a recession. And in crypto, I think people have been tempted to time these cycles of bull and bear markets. And so historically, we've seen every 4 years or so, we have seen the Bitcoin halving first. So this is when the supply of Bitcoin issued drops by 50%. And we saw the first one in 2012, 2016, and 2020. And we had seen these cycles in Bitcoin's price and crypto in general, really, first in 2011, and then following a 4-year trend in 2013, 2017, and more recently, 2021, even though I guess it's still to be determined if that's a multi-year top. And so this sort of aligns with the 2025 being the next top. So is it really that simple? So we see here, and there's tons of coverage on this, on like crypto cycles theory. It's big enough that even Investopedia, which is a reputable source, covers it. And so historically, it has behaved like that as in the halving occurs, and within a year and a half or so, we see a cycle top. 2021 was the same case, with Bitcoin topping around 69,000, and other cryptos also reaching that peak around late November of last year. So is this coincidence, or is there actual math behind it? Like, is there actual causality behind it? And so a lot of people, especially in the early days, used to point us the stock to flow model as a key reason behind this. For those unfamiliar, it's essentially a model that's applied traditionally to commodities and then has been extended to crypto. where people attempt to price the value of crypto assets based on their issuance. So that's the flow and the stock that's currently available, the equivalent to circulating supply. And we test here I have an in-depth piece on this called Demystifying the Bitcoin Halving, where I test the stock-to-flow model popularized by the trader Plan B, I forgot the name briefly. And so based on that, we've seen price climb parabolically essentially over time. And if you price in how stock-to-flow is expected to be reduced, we get a price of $17 million for Bitcoin by 2028 after its fifth halving, which by one measure is greater than all global wealth at the moment. Needless to say, even though I'm optimistic on crypto, it seems like a bit of a reach for a price target, and especially with already 90% of Bitcoin supply being issued, I think it's less likely, and the data shows that it's less likely that the halvings are expected to have an impact on these crypto cycles. And so here I have the share that miners volume make out of total volume on chain, and it's dropped from around 20% in 2015 to under 1% these days. So that highlights how essentially the selling pressure from miners is close to being negligible these days, and it's really broader market forces that are affecting the market. And so if it's not the halving that's driving crypto forward, then what? Well, for anyone that took a basic economic lesson, they'll know that that's just half of the picture, and the stock-to-flow model forgets to address the demand side. And so there are two key aspects here that I think compose the demand side that are worth highlighting, which are the players involved, the size that they trade, their investment horizon, if they're more risk tolerant or risk averse, as well as the sectors that are being developed here. And so here we cover the use cases, the adoption they have, and their growth over time. And that's what we're going to be covering throughout the rest of the webinar. So let's start with key players. So before 2013, like I mentioned, there was briefly a spike in 2011, but really until 2013 or so, it was mostly hobbyists, a few idealists and dark web users using Silk Road back then. There were very few institutions building, and even less, if any, really, buying crypto those days. It was also pretty much just Bitcoin back then, as well as a few forks of the UTXO model. And so it was highly experimental, and it was appropriate only for those with very high risk tolerance, or those who just saw it as a toy. So back then you were able to mine Bitcoin with your computer. So I guess there was less risk there if you were just mining it. But it was also, of course, seen by a way narrower audience. And here, throughout the 2013 cycle or so, we see the first few institutions building on Bitcoin and crypto broadly. So first Mt. Gox, then we see Silk Road open in early 2011. That preceded a massive increase in price. And here we also see the first change in distribution, where smaller addresses in Bitcoin start gaining dominance. And at that time also, I guess the leading narrative for crypto used to be dark web or anonymous money. But as time progressed, we're starting to get more and more established exchanges like Coinbase, Kraken, and even the Grayscale launch, which was the first fund to make Bitcoin investing available to traditional markets. And a bit later on in 2015, we started seeing ARK publicly invest in Bitcoin. Around the same time, we start seeing the first institutional investors more on the side of investing in companies in the space rather than crypto itself. And I see this interesting pattern that a lot of, well, not a lot, but a few of the Web 2 and Web 1 VCs spotted, I guess it's referred to as the internet's original sin, which is, as Mark Andreessen explains, is the lack of capability to integrate finance in an internet native way led to the internet being monetized through ads, and that's currently the status quo. And a lot of these VCs saw crypto as an exit of that model and having internet native money and functionality that wasn't possible with the ad model and Web2 in general. So that led, in my opinion, the first wave of VC investments into crypto. Then we see, as I mentioned before, Grayscale and ARK enter. Pantera was one of the first funds that pivoted from being traditional fund to their own crypto fund in 2013. But at that point in time, these represented relatively small investments relative to their overall portfolios. So crypto is still very early back then. In 2017, we see as prices reach new highs in late 2016, we start seeing again interest pick back up, as tends to be the case. So that brings a new wave of participants, both building and buying crypto. We also see Bitcoin, we also see crypto move beyond Bitcoin. And so up to 2017, Bitcoin dominance, so their share of market cap had been above 75% throughout its history. And then, of course, in 2017, we see the rise of ICOs, as well as several projects launching. And we see Bitcoin dominance drop to as low as 25 or 30%, I believe. And so the sector, crypto spreading beyond just cryptocurrency, as I'll touch into. And we see, of course, this broader narrative at that time of institutions are coming. And we like to show this with large transactions volume, so transactions over 100,000. And we see here the share of volume that these transactions make had some intermittent spikes in 2013, but following 2017, we see a lot more consistent behavior from institutions. And these days, it's 99% of all volume comes from transactions of over $100,000. And so that trend has materialized significantly. Another factor that culminated this trend of institutions that are coming was the launch of Bitcoin futures on the CME and CBOE. This also led to a change in market structure. So before, spot markets were more liquid, and following the launches in futures markets and the adoption of perpetual swaps markets, it's sort of switched. So now derivatives markets are more liquid, and that essentially leads the market now, since it drives more volume there. And in 2017, we see the second Retail Mania. So we start seeing these broader distribution trends take place. So we see here spikes in the number of traders, so addresses that have been holding under a month. In 2013, in the double bubble in May and November. And at those times, hodlers or long-term traders holding over a year sell typically their balances. This is one of the new ownership indicators I was mentioning before, by the way. And here in 2017, we see a similar pattern take place where short-term interest spikes and the balance of what hodlers decreases, as well as finally in 2021 as well. And another pivotal moment for crypto was, of course, COVID, as was for the rest of the world. And so this, especially in the beginning, began with increased correlations with traditional markets as liquidity dried up. Essentially, no one wanted to buy crypto or any financial assets during February or March of 2020. There was too much uncertainty. And of course, this brought correlations high across the board. However, as the prices started bouncing back and the situation gained more clarity, we start seeing traditional investors enter the space. So a lot of hedge funds entering, seeking high beta exposure, so higher exposure to appreciation in price as these markets bounce back up. And of course, there was the COVID response of trillions and trillions of money printing from the Federal Reserve. And this essentially led capital to move down the risk curve, as they say. So entering through bonds, the capital, and then moving to stocks, crypto, all the way to DOC tokens somehow. Even though I kid about DOC tokens, we do see several institutions taking crypto more seriously. So we start seeing in 2020 and 2021 the adoption, the acquisition, of Bitcoin into treasuries of publicly listed companies, MicroStrategy and Tesla, to name a few. And we also start seeing on the tech space long-term investors that had been hesitant earlier chime into crypto. So we see that with the sort of the largest VCs, SoftBank, Tiger, Sequoia, which even recently launched a dedicated crypto fund. And at the same time, we experience crypto native funds such as Alameda, Three Arrows, reach tens of billions, potentially even hundreds of billions of dollars worth of exposure. And we see, as I had been mentioning, that traditional finance companies start entering the space. So banks are now offering custody services for crypto. Many are even shilling some of the layer 1 protocols with reports these days. But it also acts as a double-edged sword, since now a lot of the players that are buying crypto have also exposure to traditional markets. And I believe this has also led to wider, broader, higher correlations with crypto and traditional markets. And so now that the Fed is likely to increase interest rates, we also see correlations couple back together. And this happens, of course, as career risk of getting into crypto drops both for traditional institutions as well as for people looking to enter the space. And finally, we've witnessed over the past year or two crypto entering the geopolitical space. So first with El Salvador, of course, making Bitcoin legal tender, and more recently it's getting a lot of traction from the Ukraine and Russia risk situation, I should say, with a lot of the donations taking place in crypto, and even the government of Ukraine saying that they're doing an airdrop earlier this morning. And I believe with the change of these players, which has become a lot more diverse, and essentially the investment thesis that each of these players have becoming more diverse, we see the end of an altcoin era, where previously used to be the case that was Bitcoin and everything else was an altcoin. Those days are gone, and thankfully the term has also faded into irrelevance. And so to the second point, I know the first part was a bit more on Bitcoin, but as I mentioned, it's expanded way beyond that. And so in the first altcoin era or so, around 2013, we see some forks of Bitcoin, UTXO model, such as Dash, Litecoin, Peercoin, and Dogecoin. Even though some of these are still around, I think all of these were essentially attempting to be money. And so, of course, the term starts as cryptocurrency, but we've moved on to crypto asset, which I believe is a better fitting term now that the use cases have expanded beyond money and hasn't proved to be great as money, since it's not a good unit of exchange, medium of exchange, or unit of account. And the main innovation powering this diversification in the use cases have been smart contract platforms. And so this started first with the ICO of Ethereum. And of course, after people see that this approach was successful and started generating traction, a lot of people look to replicate Ethereum's ICO and replicate smart contract platforms in general too. So we see in 2017, the ICO Mania, which reached billions of dollars being raised. mostly through illegal fundraising campaigns, I guess. And so use cases start expanding, even though a lot of the projects here are vaporware in a way, because they're just teasing a future product. The ideas of the potential of the technology start getting played around, and it also validates the robustness of crypto as a fundraising mechanism, and it starts generating utility for the network. And so even though it seemed like a large amount of activity back then, the fees generated from the ICO mania was just in the tens of millions of dollars at its peak per week in terms of Ethereum fees. And over the past few years, we've seen in the 2020s demand expand significantly. One of the key sectors driving this has been DeFi, of course. And so we see first the so-called DeFi summer in the summer of 2020, after liquidity mining starts getting more traction and expanding to more and more protocols. We see a validation of product market fit. Even before that, I would argue, with MakerDAO. And of course, these incentives of liquidity mining brings even more and more capital. So it's expanded to 200 billion these days as demand for yields grows, as yields in traditional finance dry up. And of course, I would be remiss if I don't mention NFTs as a main sector here. So we've experienced really crypto go mainstream and have NFTs redefine going parabolic. This is a logarithmic chart of OpenSea volume, and even then, it looks like if it's going exponential in 2020, now trading over $1 billion per month consistently. And I would argue NFTs really are not a sector itself, but rather have applications across multiple sectors. But maybe that's a topic for another day. And as these sectors start getting traction, so do other smart contract platforms. So they move from just a promise in 2017 with the ICOs of EOS and Cardano to a lot of these actually materializing and getting traction. And this is reflected in their market caps. So even though Ethereum is still the market leader, as you can see here in the graph, a lot of these other smart contract platforms have also gained some share on Ethereum. And even more, we see these protocols, these smart contract platforms, replicate the DeFi playbook. And so first Polygon, and now Avalanche, Phantom, Harmony, they've expanded, essentially provided liquidity mining rewards on their native tokens to those using their applications. And we've witnessed how this has just completely exploded the amount of usage that these applications have gotten. Of course, I would argue this is not sustainable long term, but it does move forward a lot of the future demand, and it's been very helpful for these networks. And a few other sectors that I think are worth discussing are, of course, stablecoins, which have grown to the hundreds of billions of dollars and are now also in the geopolitical stage. Gaming, which we started just scratching the surface, in my opinion, with Axie Infinity. Data storage, we see a lot of interest picking up with Filecoin, Arweave, and these applications that provide cheaper access to storage and also potentially more secure as they're decentralized and don't have a central point of failure. And I think there's another sector that I don't have like a clear bucket to classify under, but we start seeing more real world interactions or intersections between crypto and these other spaces. So one would be, for instance, Helium, which provides a network, a 5G network they're currently building, where anyone can provide essentially a node hosting this network. And another, so essentially this is on the early stages, but could be a real world application that can be used, powered but through crypto. And also with the growth in DAOs, we start seeing interactions between the crypto world and the physical world. So one example would be the Constitution DAO attempting to buy the copy of the Constitution. And more recently, I believe Fry's DAO raised something like $4 million to buy fast food franchises. And I think this is a trend that's just getting started, and it's likely to continue to unfold over the years. And so to recapitulate, to summarize a bit, I think we're starting to see several trends unfold in crypto that are really pushing that demand side that I think is going to be paramount in defining crypto cycles or crypto market in general. One is that we're likely to continue to see the institutional adoption primarily of Bitcoin and Ether to continue to grow. I think for financial institutions, Bitcoin might be an easier thing to wrap their heads around, and so it's unsurprising that it's gotten more adoption. But Ether has also grown significantly and being adopted by several treasuries from centralized publicly traded institutions. And I think building on smart contract platforms is the next paradigm of how tech companies will be built. We're starting to see that. And I think startups here have the advantage over incumbents, not only because of the innovator's dilemma, but also in part because these incumbents have a lot of their users are hesitant to adopt these new technologies, as we saw with Discord teasing that they'll adopt NFTs. And so this creates the opportunity for startups to lead this wave of new applications that are being built. And finally, I think the third main trend to keep an eye on is cryptos playing in the geopolitical scene. As I mentioned, we're starting to see that in the Ukraine and Russia conflict, with some even hinting to Russia evading sanctions through crypto. That's yet to be seen, of course, but I think just being mentioned there and being up to that level in the conversation is likely to drive further interest into the space. Following up on that point, I think it's worth highlighting how crypto enables diverse set of new applications. So one comparison I like to do is how the going direct model on Web2 was a major investment thesis for a lot of VCs and a major trend that we experienced. So by going direct in Web2, we typically refer to someone creating content and publishing online directly to their audience. So first, like through blogs, then on social media, more recently on Substack. And on Web3, I think we're able to, even though it hasn't been articulated that way, we're also able to go direct in Web3 with other forms of value. So not just with media, as was the case with the first generations of the internet. Now we're also able to go direct with financial services, with assets, with networks. So for instance, if you compare the cost of listing an asset on traditional finance, of doing an IPO, it's in the tens of millions of dollars probably, ballpark, whereas anyone can go direct and launch their asset on Uniswap within seconds. So I think this is a very undercovered point for crypto, and I think it's going to enable a vast number of unprecedented applications. Also, it grants the ownership component. So by being decentralized, these network participants can get shares and participate in the upside of these applications, which also incentivizes people to adopt crypto and to continue to essentially get involved in these projects as well. Finally, as I mentioned with DAOs, we're starting to see capital coordination en masse at the vastest of scales. And I think all of these applications and sectors have enough to make crypto really the next paradigm. And so here I have traditional tech S-curves of how the technology is diffused over time. I typically have a good book recommendation here, called Technological Revolutions and Financial Capital by Carlota Perez, which is a good book talking about this subject. And it also fits in very well with crypto and the Web3 narrative. So you can think about sort of Web2 here, which has been reaching its peak, many would argue, and their growth rates are diminishing in certain aspects. And we're starting to see crypto take off. Of course, it's still far from surpassing Web2, but I think with all these sectors and players getting involved, it certainly has the potential to do so over the next few years. So to conclude, crypto in 2022 looks very different from 2018. So I don't think the 4-year cycle theory will continue. It's possible that we do happen to have a bear market this year, but I don't think it'll be because of the Bitcoin halving and the supply side dynamics. Those are likely to play a way smaller role in the future. Instead, we'll see a lot more depend on the demand side, as I mentioned. And so we're seeing here diverse set of players getting involved, reaching the highest scale. So the geopolitical games getting involved in crypto. And it's also already showing how the promise of how it's transforming several sectors. So I touched here on how it's moving from the term cryptocurrency to crypto asset. And it's a good example of how it's expanding beyond crypto as an asset class to a broader technological shift and a new paradigm shift, as cliche as it may sound. And I believe 2021 was the breakout year of this future trend, and we're witnessing a pivotal moment for the years to come. So that's it, everyone. We'll be covering on the next webinar DeFi's largest hacks. So as many will know, DeFi has massive opportunities for those that use it, but also has significant risks, with over $2 billion being hacked from DeFi protocols. And so on the next webinar, we'll be covering how a lot of these hacks, what they have in common factors that people should consider, and how you can mitigate these risks. So sign up, everyone. Our team will be sharing the link here in the chat. Thanks for posting it. And of course, thanks everyone for listening. I'll be sticking around for 10 minutes or so for questions. So I'll start here with a question from Connor. Thoughts on the news that CME will offer micro options on Bitcoin and Ethereum? So yeah, I believe the initial CME futures contract for Bitcoin was 5 Bitcoin per contract, which of course has been a prohibitively high price to pay for retail users. I think at the same time, though, micro options, like there's not that big of an overlap between the people that trade in the CME and people that trade under $1,000 positions. So I think it might be a bit oversold in the media in terms of its impact. I think people that want to trade options in crypto, like some might feel more comfortable doing it in CME and these traditional spaces, but a lot of the people that do that already have the capacity to do with a larger trade size. Whereas micro options and smaller trades, I think, are a better fit for crypto native derivatives. So I have an anonymous attendee asking here, what are your thoughts on some of the barriers to entry for businesses small and large to integrate these new technologies to unlock value? Yeah, so I alluded to this earlier in the slide where I mentioned that startups are likely to lead building on smart contract platforms ahead of incumbents. I think especially large institutions have a lot of barriers to adopt these technologies because they have wider audiences, and the broad audience is still very much uneducated about crypto. And they also have the majority of their revenues come from verticals that might be at risk from investing in crypto. So it's essentially a lot of these large institutions would have to forego money in what they're currently doing in their established businesses, generating millions of dollars, to go into a risky, like yet to be proven really sector or set of sectors. And so I think there's a lot of barriers, not just from education standpoint and their users, but also from structural issues. A lot of people call it, I think, well, not a lot of people. In innovation theory, they call it organizational inertia that companies have. And so that's also why we see typically startups lead the way with this innovation. And once we start to see the technology be more proven, then a lot of incumbents will be able to, or are more likely to, get into crypto. So another question from Jaime: if Bitcoin does not create a higher high in 2022 and a bear market proceeds, what are your thoughts on the altcoin market? So I just said how the altcoin market and the altcoin term is kind of dead, but I get your point regardless. Crypto, smaller tokens are really likely to see less of a bid if liquidity diminishes. So here I'm paying a close eye, not just on interest rate hikes, or more importantly, I would say on quantitative tightening. So if essentially liquidity starts leaving markets by the Fed selling bonds, I think, as I mentioned, that capital moved further down the risk curve. I think we'll start seeing the opposite take place. I think I mentioned it here. So as a lot of capital was printed and entered markets, it moved further down the risk curve from stock, like, I don't know, value companies to growth to crypto. And I think we might see the same in to DOC tokens, I said. And I think those that don't have a proven track record might be hurt, particularly in if we see a broader bear market. And here, I don't think it'll be Bitcoin versus the rest. I think it'll be those that are proven to have product market fit and revenues versus those that are just vaporware. And still these days, we see a lot of projects in the top 100 that are a white paper and some research being done. Not gonna name names, but there's also projects like MakerDAO, Uniswap, DYDX that have tens of millions, maybe even hundreds of millions of revenue. I think even billions in the case of Uniswap. And so these are like more aligned with like the value frameworks, and those might, even though they've already corrected significantly, I think we might have essentially a pivot towards value plays that are more proven to get demand. So I think Ethereum also falls under that umbrella, as well as a lot of the layer ones like Solana and Avalanche that are getting more traction. So I don't expect it to be Bitcoin versus the rest like happened in 2018. I think it'll be more those that are proven versus those that are just empty promises. Will markets become more efficient, less volatile as more institutional investors get in and more regulations kick in? Eventually. I don't think that'll happen this year, really. I think there's very much still a lot of volatility, especially because there's a lot of uncertainty. So even though I think they're getting more efficient in terms of pricing in items, so you see the markets react algorithmically to a lot of the things coming up to a degree that wasn't the case as much before. And a lot of correlation bots sort of, I don't know if you would say efficiently, but trying to drive prices quicker. I don't know if that translates in less volatility. For the foreseeable future, I would say no, because there's a lot of uncertainty in the macro standpoint. But I believe in 2025 and beyond, as crypto establishes as a technology affecting broader sectors, as I mentioned, I think then, yeah, we're likely to see less volatility, but might still be a while until that. Nenko's asking market floor estimation based on previous bear markets. How can we come up with some estimation? So I guess you're referring to like how low can crypto go? And I think this is a sucker's game. I think these predictions can often hurt more than help. A lot of people have technical analysis on where they think crypto can go. We look at on-chain data and we see people addresses that have been accumulating over time. I'm pointing actually on this slide. So hodlers are increasing again. So I think timing the market, as tends to happen, is very hard. But we still continue to see a lot of interest, especially from long-term investors, continue to grow. And so I would say it's still very hard to see if we'll go back to 29,000 or if this was the bottom. There's a lot of uncertainty, as I mentioned, so I don't think you can correctly price that. What can you share about the custody risks for large institutional investors as one of their main barriers? Yeah, for sure. So in terms of companies adding crypto to their balance sheets, it's a technology that they're unfamiliar how to manage. At the same time, though, there's very large companies such as BitGo. I'm forgetting the name of the other large player, but there are very large custodians that facilitate this process. And these days, it's a very simple process for companies to buy crypto and have it custodied by these large centralized custodians, which I guess I understand the irony of having a decentralized asset custodied by an institution, but at the same time, it's unrealistic for a lot of these large institutions to get comfortable with crypto. I think that will take longer, way longer, really. But I think this year, especially if inflation continues to grow, we'll likely see more and more companies adopt crypto, especially if Bitcoin continues to outperform, as has been the case past few weeks. Okay, so last question. Do you know if IntoTheBlock will ever get into ratings / understanding risks associated with certain cryptocurrencies by some type of scoring method? Donald, you read my emails or something? Just kidding. This is actually one of the topics that we're working on. I don't know if it'll productize into risks, but I'll be mentioning all about that in our next webinar on DeFi risks. So it's a process that we have been using internally for the quantitative strategies that we manage for our partners. So we'll touch on this subject here. Make sure to sign up. I see here the link's been reposted. So thanks everyone. Hope you all have a great day. Bye everyone. Thanks again.